We are then going to look over the statement they're going to produce in 2 minutes, and then we're going to listen over the press conference. I am going to scalp that at the best of my ability, but we will then go through and see how things is going. So the reason why I made this live today is, well, I'm too tired to do anything else, but we'll try and see how things plays out. Okay, good. The other thing is that CMB Group is now crashing down. Yeah, that's always great. Is this one here? We are looking for the interest rate, and we're looking for the forecasted economic projections as well at the same time. So, other than that, I think we are good to go. Financial juice coming up there, and then what else do we have? Probably wrong screen. Okay, good screen. Okay, just gonna take that away. Good, and then we're gonna move it over to another screen. Good, and then I just brought over my broker there. Good to go. Good. Anything on the other questions? Is there any other questions? Good. That is all awesome. If you bothered to become subscriber, probably should, because there might be something end of it. Not at all, Carlos. So let's see what is coming out today. Are we coming in at 3.25, or are we going in higher? I just want to see this one before I go over. There it is. No, it is. It is at least 8 p.m. now, so that should be in any milliseconds. Australian dollar, US dollar is down at the moment. Euro dollar is down at the moment. We're going down another 50, not 50 pips. We're going down 20, 15 pips there. We got the 75 basis point rate hike as we wanted. Let's go over to see if we can see the statement. That would be great. 21st there. Good. Recent indicators point to modest growth in the spending and production. Job gains have been robust in the recent months. Unemployment rate has remained low. Inflation remained elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressure. Not much different there. Inflation remained elevated, reflecting supply and demand. That is kind of as they did last time. Dollar is skyrocketing, euro is falling, and we are making money as we speak. Now we are down at least another 20 pips on the euro. We are, if I can just load it, that would be great. There we go. It's only that one. There we go. Where was it? There was there. Thank you. Yeah, 50 pips there, 45. I can't even count. Sorry. But that's a good day on the job. Now we just have to wait for the rest of the comments later on today. CAD yen, Aussie yen, USD yen is almost not Euro yen. Wow. All right. Okay. I like that. Euro yen is going lower. That's a nice little surprise there. So yeah, good to go. Can't complain about Euro yen going lower. That is kind of what I'm hoping to see all day. Not really. Filio says, Pascal says, fast recovery. Thank you very much. Hi, Samson. Hi, Kevin. Hi, Henrik. Hi, Eman. Welcome from the Czech Republic. Is it going to be a drop on major pairs? That's kind of what I'm expecting for it to be. More than anything else. So we will see how things plays out. This euro yen is different from the euro yen that I have on my broker. Okay. Maybe, yeah, because my broker is all the way down here on the candle. And this one is pulling back pretty hard. They even have the same time frame. This is the weirdest thing I've ever seen in my entire life. All right. Euro dollar pulling back. That's always good. And then we can should we sell euro now? That's the question that everyone's asked me earlier today, apparently. And the answer is, yeah. Do you like it? Is it good enough now to sell it so late? Sure. You can put a limit order on the euro there. I'm just going to make sure it's not too high. 38. Yeah, fair enough. Having a small pullback there, and then we sold, what was it? 98.37. I have a 100 pip stop loss on that, and then we shall see how it goes. Why did I sell euro dollar? Because I think euro dollar is going to continue lower. It's just a scalp, anyways, and I'm currently losing on it. And if I lose enough money for me to still go to the dentist tomorrow. So what kind of questions do you have today? I have not updated myself or anyone else on the market lately. As you remember, we sold one up here, so we are well and dancy in profit there. That is down 170 pips ish now. So I don't know. Good job, mate. We are breaking lower on euro. We have made a new lower low now. And if you go over to euro yen, more on the yen pairs, we have kind of made a new low, but not fantastic new lower low. But it's a new lower low regardless. The other thing that I want to look after is pound dollar, which has a much deeper fall today. I wanted to comply before falling, but that is nevertheless the current 5-minute candle has been priced in, has stopped, sorry, and I would like to see a comeback up to 618, 68, sorry, 618. And then, so that would be around this price before selling. So, if so, 1290. If so, what else, people, should we be thinking about today? Monthly take profit on pound. Okay, then I probably shouldn't do that. Is it actually monthly take profit right now? I know New Zealand did it. Oh yeah, okay. Yeah, I'm not gonna sell it then. I'm not gonna sell it then. Scusa. Should I hold euro? No, euro still has moved down to 97.50. Yeah. I got, how much did I get out of it? 6 pips out of it. 6 pips, 8 pips. There we go. Got out of that one, so I got 8 pips on that. But I want it to come higher with Powell. Australian dollar, as you can see, is falling hard. Australian yen, by the way, just for everyone to update on that as well. I got stopped out of that one from 90. It was New Zealand yen, maybe? Yeah, it was New Zealand yen. 84 entry. I had an entry somewhere around here, so I got stopped out of that today at break even. But I still took profits up here, so that's all good. Small Will Nerd says I just sold your dollar, 35 pips. I was out. Yeah, I got out of it with 8. Want a bit of a deeper pullback before I want to sell it again. Pound dollar hit monthly target 12.67, so nothing else than that. Yeah, I'm supposed to look at that, mate. Summary of economic projections, Mr. Change in real GDP, and I want to see the dot plot. They are thinking longer term 2.5, but they think 2023. Some of them almost thinks up to 5. So the market has been surprised with higher expected rate than we previously thought, as far as I can see. Because I think it was supposed to stop at 4-ish. Fed funds rate by end of 25 is 2.9. Forecast to be 3.9 by the end of the year. Previously 3.4. I'm just going to show you what I'm currently rating out. That is higher than expected, or higher than the last time, sorry. Which has an effect on the market when the actually Fed comes out with those numbers, even though it's already priced in. So yeah. Median projected Fed funds rate is 4.4, up 3.4 in June. And then futures after FOMC decides to apply traders to see 89 chance for another 75 base point rate hike in November. If we look at Mr. Stock market at the moment, and I think that should be pretty down. Yeah, but it's down. Both S&P, Nasdaq. I saw earlier today that people were like taking profit of their sells, and I was like, "Why, sir? Why are you doing such things?" So that's that, and then growth coming in at 2 point. I saw it, but I lost it. Sorry. Another one for 75 basis point in November. That is, I believe, the reason why the market is actually reacting right now, to be honest. Let me see if I can do something. That would be great. Sorry. Seems to be the hardest word. I can't move my... Oh, there it is. Thank you. Sorry, people. So, good. Where are we? Tomorrow, GPB is also giving a raise of 75 basis points. What's the view on that? Well, they are raising interest rates going into the meeting. They're raising interest going into recession. So I think they're going to disappoint on the outlook. So that should send pound lower. But there's always a risk of something, right? There's always a risk of something. But yeah, it's always a risk of something. And Aussie is the one falling hardest today. Aussie yen also falling still. Yeah. So I had a sell there earlier and a sell there earlier. So it's still going, according to my plan at least. What I'm worried about, okay? I'm worried about that we make on the yen pairs a candle like this, a big long one. If that happens, that might be the bottom of it. I'm all I'm saying. But dollar pairs, yen pairs, Aussie yen. Look at my master trade on Aussie. Didn't I take profit on that one? Well, I'm sorry. My brain is like a goldfish today. Yeah, I did take profit on that one. So I'm still not in it anymore. So sorry, but I did take the entry though. But I'm out of that one. So yeah. What's your view on CAD pairs? Is probably going to fall more. Nothing particularly for why, Poppy? What do you mean? Like yen pairs has been great. Dollar pairs has been great. If you want to do the projection, the wrong. Sorry, I'm so slow today. It was almost that one this week. So yeah. Hello, Joe.
Hello. Can you hear me?
Yeah, I can hear you, but I can't see you.
Yeah, I'm still in the middle of moving. My webcam got
You're
all
still
packed
moving,
up.
mate.
Yeah, man, it's been a hassle to say the least. It's been a big old hassle, but it hasn't stopped me from working on my stuff and being a part of your community.
I forgot to ask you though. I'll probably have to ask someone, but if you wanted to do the daily setups today or tomorrow, but because I'm not gonna do it, but I'll have to ask if they want to do it. If they want to do it, but that was my thought earlier today, and I have no filter today. I just say whatever is my brain today.
Yeah, man, you've been out of it to say the least. You need
Hey,
more
look
help.
at me.
You can lean on me a little bit. I'll be fine. Although I'm in a
Nah,
way different time zone than you, but that's
yeah,
also
I
a good
know, I
thing.
know.
It's also a good thing.
For those who
All
doesn't
right.
know what I'm going through at the moment, I am so incredibly exhausted that I just sit sometimes at the computer looking at it, and I can't move, I can't think, I can't do anything, and I probably shouldn't do the stream either. But here we are. Here I am.
Well, so many
Um,
people said do this one stream absolutely. So I'm happy to see that you're powering through it. You look really good, my man. You look really good.
yeah, yeah. Thank you, thank you. And there's been Twitter drama lately, so yeah, I've been. I want to go back into the atmosphere. IBIS says dollar strength, no strength or neutral on dollar. Absolutely, strength strong. Um,
Yeah,
no
man.
jokes about that.
I mean these dot plot forecasts. You have the dot plot up, right? At page 4, summary of economic projections. Last
Yeah,
tab over there, I think. Yep,
yeah.
there you go.
Which
Yeah,
page?
yeah, there we go. Oh, you already have it up. Oh my
Yeah,
god.
you send me it. I pulled it up,
you
mate.
Yeah, man. I've been sending it to absolutely everybody. I'm on
Uh,
top of it because I got the email right out the gate. I took the snapshot of it, sent it out on
uh,
Twitter. I'm farming Twitter likes right now.
all right, but I can't do it. I can't
But
do
you
it.
know what's important
So
about
what's the
that dot
what's the
plot
deal about it?
change?
Yeah.
The expectations for 2022, 2023, the rate hikes are way higher than what was expected going in. I mean, don't get me wrong, the expectation was that, some of these dots would be in the 4.2, 4.5 range. We're talking about 4.75 and like very close to 5%. Like this is very aggressive projections
Mm,
where we could potentially even see hikes into 23, where the Fed
yeah.
might not be done hiking, quite
Mm,
frankly. The Fed might not be done hiking in 22 if they're not satisfied with unemployment and the unemployment level and the inflation level in 23, like first, second quarter of next year. So that puts more risk on the table for even more dollar bullishness right now going here into the end of the fourth quarter. A
yeah.
lot of traders were expecting, these dot plots to be lower by like 25 to 50 basis points, the median
Mm,
projection. But that's not what's happening. What's happening is that they're higher. So now you have to push up your timetable as far as when you're going to hit certain price targets. And considering how much more aggressive the Fed is relative to other countries, that's going to make the United States even more of a safe haven, more aggressive of a push. And I have a feeling that there's probably a good political reason for this, that they want to accelerate the dollar strength to make it harder for China, make it harder for Russia. So I think that there are reasons, geopolitical reasons for this happening. And not only that, but a stronger dollar will sort of also incentivize more people to probably do more U.S.-based industrial reinvestment, and that'll build up LNG and our energy exports again, and effectively help get Europe the energy it needs. So there's a lot of moving parts here politically that I think are affecting these FOMC polls outside of just the Fed mandates. And I think that's probably one of the reasons why the Fed has been talking less accommodatively. That's kind of been their theme recently. They've been saying less and less, giving us less insight into their decisions. They're still, they're saying the minimum, right? They're saying the absolute minimum they need to keep markets on top of things. So while what I'm saying is frankly just speculation, I'm pretty sure, based off the current forecast, where we'll see like Russia in massive depression going forward. China's not going to be doing too hot right now. They're losing all their business to India. India is deregulating. Like the next decade, the United States could totally wipe out its enemies and have an even stronger dollar, and more people could be using dollar. And the amount of liquidity in the entire world right now of US dollars is still really contained. That's why dollar is getting so strong and expected to get stronger. There's just not enough dollars. When 70-80% of the world is transacting in dollars, it's kind of hard to do business when you run out of dollars. It's kind of hard. So, and I mean, I'm not even talking about like the United States and Europe. I'm talking about like European countries and African countries and Asian countries. They're dealing with each other in US dollars. A lot of commodities, oil, are transacted in goods that are being transacted in US dollars just because of how strong it is and the future outlook it has of really being secure economically. It doesn't say a whole lot of good things about Belt and Road. Belt and Road isn't doing so hot either. I mean, there's so much going on in the world right now, and dollar strength advances a lot of the United States' geopolitical goals and economic goals. So there's more incentive for dollar to get stronger. I mean, for many, many, many more months. And at this point, it's like, well, when do you see the reversal? When does the pain stop? You see it stop when there's a significant change, frankly, in, I don't know, like policy. Russia surrendering, or China commits to not invading Taiwan. Like at this point, things are, when you have more geopolitical uncertainty, countries tend to use their financial instruments as geopolitical weapons. And I mean, we saw that with Trump, right? I mean, guys, Biden is no different. We saw that so much with Trump. This is that Trump actually communicated it. Biden isn't communicating at all. Like, everyone just makes fun of Biden.
Especially America, yeah.
Yeah. I mean, it's really insane, because now it seems like the people who are likely calling the shots now with the dollar as far as the United States' policy, they're not out there openly talking like on the news. Like, wasn't it so much easier to predict what the Fed was going to do and what the expectations were going forward under the Trump administration than it was right now. Just even just these first 2 years in Biden, we've had a lot more uncertainty as to what the Fed is going to do like a few months ahead of time. Because it seems like there's other things kind of pulling the narrative. And that's where I come up with like, hey, you know, maybe there's some geopolitical thing going on here. Yeah.
The other question that Rafael has is, why is yen stronger at the moment?
Why is yen stronger? Is USD yen going down? No,
Nah,
USD
I don't
yen's
think
going
USD
up.
yen
What
is
is he
going
talking
down,
about?
but yen pairs fell, right? And if you look at yen in its, well, yen actually fell, Rafael.
Oh, you're talking about
So
like the index and all that. Well, that's because
yeah,
when
so
dollar gets stronger, it hurts risk
everything else.
on. And just because, and look, you know, there's more discussions coming out about the Bank of Japan actually not hiking up until March. There was a great interview that was recently released covering Brent Donnelly. You know how much I like him. And he gave a really simple explanation like, hey, yen, I mean, I don't see this as a very, long holding move, this yen strength that we're having today. I don't see this as a move that holds particularly long. At least, especially against the dollar, I see dollar yen going up, 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 and away, and just literally, you could probably just see the price of dollar yen fly off your monitor into the ether. Like, this could get really crazy. You could see dollar yen go into like the 150s because the current Bank of Japan head, right, the chair, Kuroda, he's just not going to do anything. He is now just more focused on his legacy at this point. He's not going to change anything. He's not going to hike. He's not going to cut. He's going to be known in history as the man who killed Japanese deflation and Abenomics with Shinzo Abe. They'll be known together as the people who killed Japanese disinflation or deflation. And when in March, April, the next chair of the Bank of Japan comes in, then if they screw it up and they hike or cut, then it's on them. But at this point, the world is becoming a lot more geopolitical at this point. If you don't know what's going on with the people who are running the world and what they want, it's actually harder to figure out like the 3 month, 6 month out view. And in order to know what you want to do maybe for the next month, strategically, you probably want to know what the overarching theme is, right? And that can be really good for finding specific days like today as catalysts for those greater goals. So, that's why you have a whole top-down analysis. Go to your monthly candle, go to your weekly candle, go to your daily candle. But some things aren't on the chart. Some things you just will not see on the chart and will not make sense. So, that's one of the things that makes trading so hard and why everyone needs to watch you and listen to you, because these are, trading is not an easy topic.
Trader Nick comes in and says USDN to the moon.
Oh my God, absolutely.
I know you have been buying it. So I don't know if you have taken profit yet, Mike. But yeah, good on you.
Yeah, I saw that trade. That was holy crap.
I can't remember your entry, mate, but it's definitely not 144. It's probably lower. So 143, 142 ish.
Ivan, Nick's probably kicking himself because he's been going long and exiting his lungs on USDN for like the last, I don't know how long, few months. Definitely throughout August, he was also going long USDN. He's like, oh wow, well, this has moved a lot. I should be a rational human being and look at all this money and take this profit.
Yeah.
And then you get out, and the thing would move another 100 pips. Like, oh my God.
Yeah, you bought 143 flat. Yeah.
It's just been so crazy. I mean, yeah, it really has
Nick,
been.
you should hold longer.
Dude, no, Nick's been doing fantastic. He's been making money.
Well, can't complain about that. There is the what do you call it? She's called what? It's called the Fed press conference or something like that. In 2 minutes.
Yeah, want to
Who's
watch it?
gonna-
Oh,
Well,
are they in the elevator music phase right now?
we are in the elevator phase, but I haven't shared the sound yet, so it's only for myself at this point.
Oh, well, let's get some non-copyrighted elevator music and just play this in the background. do 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 do. It's playing it's playing the elevator music theme of what is it? I forget what the song's name is. Girl from Appanapa. I forget.
Okay, some local town somewhere. Put a music on that. Well, I put it. I'll share it again so we can not hear what he is about to say in a couple of 30 seconds, actually, on my time at least. I got a notification today: buy dollar, yen, sell euro, pound, and Aussie. I think that's a pretty good prediction, and I made that alert a couple of months ago, so pretty all right, to be honest. But yeah, was it now? 2 seconds left. 4, 5, 3, 2, 1.
Yep, I hear it.
Heard it. And if it doesn't come out in like 2 milliseconds, everyone will be like, "Where is he? Did anybody take him? Where is he?" Called yen at 143. Trading stops. Used yen have been very kind. So yeah, can't complain. The only question is, people, is there is good. There's no other questions, Your Honor.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer run normal level. Inflation remains well above our 2% longer run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term deflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
I have a
Hi, Chair Powell.
question.
Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
Where's
So
gold going to
I
go,
will
sir?
I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So
Market believes
the
differently.
way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out, but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was? Is there a point in time you could see pausing? Is it linear that you keep raising rates, or is there, oh, I'm sorry.
I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy? The rate increase time to catch up in the real economy. Thank you.
So I think it's precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time, but we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly in my view and in the view of the committee, there's a ways to go.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that, I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know, you look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings. And you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about, you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here, given there's some discussion now of overdoing it. What's the incentive to continue front loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby. Thank you. Colby Smith from the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I, just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives. In our case, the dual mandate, maximum employment, price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers, and it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us, and vice versa. The forecast that we put together, that our staff puts together, and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it. It's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times. But really, we're in very different situations. But I will tell you that our contact is more or less ongoing, and it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong. But there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening, but you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right.
So far, what have they been mentioning? So far, they have mentioned that labor market is still very tight. Hope you guys can hear me. And businesses are still not getting jobs. He said at the end that people still has a lot of cash left in the bank, even though less now in the lower income spectrum. The other things that I saw that they expected it to be at around 4.6 by 23, and Raja said that it won't with that. Well, that's already priced in, right? No, it's not. It is 28% for 425 to 450. And if that was supposed to be priced in, then the most likely scenario would have been 450 to 475 to be in line with the Fed. That's why I'm surprised the dollar is falling as much as it does. But as I've gone through, as you guys have seen, when you have gone through the dollar pairs with the pivot points on, and you look for targets, for example, for pound, we hit the monthly target today, I think it was today, and then that is that one. New Zealand dollar, we have hit it. Australia, we've hit it. Euro, we haven't hit it yet, but we had hit the weekly instead. Most of the yen pairs are actually unbothered. They fell a bit. New Zealand is pulling back. There's the yen coming around again, but CAD yen is, it's just there. So I think that might be the reason. But also bear in mind that this is just now this CAD. That doesn't mean anything for the future. As you can see here, we've hit the target for the month on dollar. So if you're thinking, well, I should probably sell it or buy it, well, you might want to wait for it to come back down again. But as we have seen before, even though hitting the target doesn't necessarily mean it will stop there. But that was 27th of July. This is last time we had a meeting. That is there. There it is. We hit target on the month, came down to next month, and then went back up again. Yeah. Anything to say there, Joe?
I was looking through the pairs that you were just mentioning, and I was looking at Aussie dollar. Well, want me to share my chart?
Yeah, sure. I'm just gonna stop share screen. Yeah.
It is, by the way, I do have light mode on, and I know you're just coming from dark mode, so I'm just giving everyone a heads up. This screen's about to get blindingly white. Alrighty.
Okay.
Let's see here. Screen share. Yes, I do want to screen share. In fact, yes. All these.
Why?
All right,
Is
there we go.
Is there something we shouldn't see on your computer?
No, it's just asking me to hit yes, a bunch of yes buttons. All right, so yeah, I mean, I don't know how obvious what analysis I need to give. That looks pretty obvious. Like, do nothing for the rest of this month on Aussie dollar. So we're looking at the Australian dollar, US dollar on the Oanda exchange. This is a daily time frame. And what we're looking at here, these bars that go out into the future, are a seasonal forecast. This is an indicator I got in alpha right now, getting a ton of feedback. Ivan's helping me out with it. And yeah, this is a pretty strong seasonal forecast going forward. And these big boxes here are just saying, hey, what is your historical likelihood seasonally in, for example, the month of September of getting your low between any two pivot points? So, it's a lot of words to explain what it is, but so long you know what it is, it can be pretty darn helpful. Yeah.
So right now you think that Australian dollar, for example, is going to go higher for the...
Well, not right now. No. You can actually, maybe I should do this because I'm looking at the screen and I'm like, dude, all that text on the bottom right, that's a little difficult to see, man. So I'm just going to make that large. So you could use this with Trader Nick's Edgefinder. Because Trader Nick's Edgefinder will cover a lot of macro stuff, and his seasonality goes over monthly seasonality. This will go over daily seasonality and give you the expected value for that trading day and tell you, for example, how many times that day was green or red. That's what this whole dashboard tells you. And if I do this real quick, we can do this. Calendar labels. So if you just look at this, you can't really tell what day this data lines up with. So yeah, now we have little numbers here, and it's going to tell us, hey, this is the 22nd trading day of September. Let's go over here. And this is the data for the 22nd trading day of September. And it also tells us, hey, we only have 9 plus 3. So we only have 12 data points compared to all the other trading days, which have 20 data points. So just flat out, if you look at this, the net expected value. So the average return of all the bullish trading of the times that these trading days were bullish ahead of us, minus the average return of the bearish trading days. That's what this is here. So average return of your bullish trading days. So that's all these numbers right over here. And then your average return of the bearish trading days. That's all these right here. I mean, look at this. This trading day is red 70% of the time, but the net expected value, like in poker, right? If you're a professional poker player, you win and you make your living based off expected value. And that's how casinos make their money, is expected value. If you have negative expected value over a long enough period of time, you will go broke. So that's not particularly helpful if you're going, long. But then again, the more data you have, the more accurate these statistics will be. And if you have a small amount of data, like on this day right here, it's only got, I don't know how many of you guys took a statistics class, but 12 is not enough. 12 samples is not enough.
Yeah,
too much variance. Too much variance. Yeah. But the net expected value from here to here is just flat. It's not fantastic.
Yeah.
Until you look at this, then you see a bunch of green, right? Net expected value is actually
going into October.
yeah, and then most of the trading days are also green, and you actually have 20 samples minimum for each of these trading days going forward. So the outlook is on an expected value basis during the month of October a lot more productive on, if you're looking for a trend right now. If you were doing options, right, you could do a strategy expecting things to go sideways into the end of the month, right? And that would do fine here. But if you're doing spot FX, this is, unless you're trying to buy some low of some range, some smart money guys will say, hey, this breakdown here lower for FOMC is a break of liquidity from over here. I know how they do their analysis. And you know what? I have additional data that can corroborate, hey, here are some situations where that liquidity argument could work and won't work. So, I'll stop screen sharing now. But yeah, this is pretty cool stuff.
Yeah. Hi, Ben. Thank you, by the way, Civilized Moneymakers. Hi, Ben. I was wondering, why is that other central banks meetings isn't as volatile as the Fed meeting? Well, because everyone cares about Fed. America is the greatest economy in the world, and America always is always the best. Now, it's basically because there's a lot of financials is going through the dollar currency. A lot of things traded in dollar. A lot of economies is dependent on the dollar value, and a lot of people are negative or possibly affected by the dollar. And then we have one of the biggest economies that has an interest rate that everyone else is then depending on, or most of us is depending on somehow, some way. So it's just that the whole interbanking, the whole financial system is dependent so much on America that we all want to and are interested to know what they are doing, because everybody else will follow in line next. Though that means that most of the bigger money is going to be traded in dollar somehow, some way. So if they are either afraid of what America's going to do next, or what. The other thing is, most of the safe money is going to dollar. If you're afraid, you go to dollar. You go to America, you go to buy bonds, you hide there instead of hiding in Sri Lanka, for example. So, for lack of a better country. So yeah, why? It's just how the whole financial work system and is set up, and is people and curiosity. Is it possible that everyone would stop using dollar as a global reserve currency?
No.
Well, yeah. Also, you see India now; they are buying oil from Russia. China is trying to trade with Russia, though. Russia has now become a problem for China and India. We're seeing signs of it, but it is so far away from reality. Because you're going to make a lot of transactions, and you have to basically ruin the whole American economy, which is 75% dependent on itself. So it's trying to destroy a nuclear power plant. It's possible, but you need to use some explosives to do it, and it has to be willingful. Any other answers there, Joe?
Yeah, dollar is only getting stronger and more important and more entrenched going forward. I mean,
why is it the most volatile event of all the central banking meetings? Why is it moving so much?
Well, because the rates came out higher. That's why it was more volatile. The expectation was that the dot plot was going to be at 4 percent, 4.25, and right now you can actually see that's what is kind of priced in. If you go to the CBOE, I believe the CBOE FOMC expectations, that's kind of how you can find out, okay, what is the market actually pricing in. If you look at the current contract, it looks pretty straightforward. Looking at the contract for December of this year, things got pushed up like 14 December 22. Yeah, end of this year.
So this is the current meeting.
Yeah, that's the current one. Yeah.
And then now we are going over to November. And currently we are pricing in another
75.
No, it's 50.
50?
No, wait. What?
Well, remember what the guy said during the meeting. The implicit rate hiking path going into end of year is 75, 50, 25.
Oh, yeah, okay, I need to calculate the current one then. Yeah, because they haven't updated that yet. So we're currently at 300 to 325, right? So 300. Yeah, okay, that's another 75. Yeah. Sorry, my math didn't math.
Now, the problem going forward is that if unemployment maintains its current level, it will give the Federal Reserve more room to hike more. So if unemployment stays stable, it will give the Federal Reserve more leeway to hike at a faster pace to bring inflation down even faster. And guess what that's going to do? It's going to make your markets more volatile, right?
Before finishing, please do a summary. We'll do. We'll try. Euro's currently making a comeback. Yeah.
I don't know, man. It's still down 80 pips on the day.
Yeah.
I mean, it's down pretty bad.
I was just about to make a dirty joke, Raphael. I know he can take it, but I don't know if YouTube can take it. And I'm just gonna put onto the account that I'm sick. That we can put it onto the crazy account. So do you have any summary of what Powell's been talking about today, Joe?
I do know a cheat sheet way of getting that. It's from Financial Juice. They usually have a little tab. I mean, look, if someone's brand new to doing any sort of fundamental research, one of the easiest ways to reliably stay on top of things is to have a website like Financial Juice bookmarked and memorize the URL. So as soon as stuff is going down, you can figure out what exactly is going down. So yeah, right there at the top, the need to know market, Fed Powell's median policymaker sees 125 basis points of rate hikes by year end. That's already expected. Fed Powell's, there's a sizable group that would see 100 basis points by the end of the year. So some people are a bit dovish, but then again, 25 basis points ain't going to make that big of a difference, which is kind of where you see the divide in the pricing over on the FOMC CBOE website, where people are kind of divided between 4.25, or rather we're kind of stuck in this forecast range between 4 and 4.5. This entire, from the low end of the range to the high end of the range, you kind of have 50 basis points to play with, but it's all above 4% on the rate. And whether it gets to that higher end or that lower end, you might just end up going into that higher end and having more upside risk. Again, on the assumption that unemployment is stable and is not going past like 5.5%, 6%. Because that's a Fed mandate. If unemployment gets crazy, then they would at least stop hiking. And if unemployment really got crazy, 8, 9, 10%, and increasing, you're going to see cuts maybe at that point too, especially if inflation is around like 3% or something. Yeah. So it says projected median Fed funds rate at the end of 2022 is 4.4%, up from 3.4% in June. So that's why we're seeing the volatility in markets, because the volatility in the people who with all the power in the world are updating their forecasts of how much the money is going to cost you, of how much dollar liquidity for your country will cost you.
I was also wondering too, guys, how is that Swiss currency dominating US overall if US rates are higher than Swiss? Some fundamental stuff kind of throw me off. Okay, so by the way, civilized moneymakers, sorry, a deep appreciated $5. Absolutely, I'm sorry for my delayed reaction, by the way, but you don't need to do it, but I definitely appreciate it.
I got a good
You
answer
never
to
need to
that.
do it, but it's you know, and I see the reason and really appreciate it. So the thing about Swissy, in particular, you have a market that believes that they're going to increase rates hikes more. So it's kind of like a newborn to the rate hike cycle situation. Um, so there is more strength coming into Swissy because of the elevated inflation that they see. It's also a bet against the central bank of Switzerland, the Swiss National Bank, that wants the Swiss to be weak for export reasons. So that's more of a battle. That's not necessarily anything against the dollar to say in particularly. You can also say there is a risk off a sentiment here as well, where people want to fly to safety. So those are kind of my three reasons for why Swiss is stronger and why USD Swiss is falling, or was falling at least. But ultimately, dollar will take the charge, no matter how you flip and flop it back and forth, left side or anything. Because if you look at USD Swiss, just for comedic reasons, yes, it did fall quite hard in this situation, but at the same time, dollar did also fall at that same situation. So it's still very much dominated dollar moves out of this one, though Swiss is probably not the one you're fundamentally supposed to be trading dollar against, anyways. Have you covered UJ? We have talked about UJ for quite some time. I haven't bought it yet for fundamental reasons, but it's still there at a target for the month. So if it comes down, that would probably be just what do you call it? Blessing in disguise. Got stopped out of Swissy yen today. I don't know. I haven't seen you doing that though. Fair enough. Pascal says if the market expects a November rate hike, 75 basis points hike, this means dollar will strengthen further after a technical pullback. Yeah. That's already priced in the 75 basis point rate hike, but it comes down to US CPI. Where are we now? Is it 10th of October? Maybe. I think that's when it comes out, give or take. The release schedule of that one is okay. By month, 2020 probably. October, November, December. My brain doesn't work. I'm sorry, people. You just don't do it. There we go. CPI comes out. Can you see it? There it is. 13th. Yeah. So dollar will probably strengthen up until the CPI, and then after that, we'll see how things goes. And then we will have a reaction when the unemployment comes out of NFP around 7th. Then we will see if, is this dollar strength going to continue? Are we still going to continue the rate hike? So those are the two factors going forward, mostly being the CPI. Do you have a Discord room? Yeah, it's in the description. So that makes sense. So since Swiss isn't really fundamentally currency to look at, not against the dollar. So we basically have the same reaction on the next hike as today, and if it comes out as expected of 75 basis points, yes. This is kind of the normal reaction pattern that they have. The only thing that would have been different today would have been if the market would have priced in or reacting more strongly to the higher than expected projection of rate hikes at the market. Yes,
It'll
Joe?
be interesting to see how many seasonal holiday jobs are picked up here over October, because that can almost artificially keep unemployment low. So you could, after, during the holiday period, usually there are a lot of temporary hires just for the holiday period, and that could actually help keep unemployment low. And then once you get towards January, February, you're probably going to see that hike in unemployment. So the Fed probably wants to be complete with their hikes by that point in time, so that then any sort of bounce back from the temporary gain in unemployment, rather, you could say stagnation, the flatness in unemployment, right? There's just higher unemployment risk going into end of first quarter next year than there is right now. So the Fed's going to hike as much as they need to right now. There is some upside risk to these forecasts, but that would literally only come if the unemployment starts going higher now. Like we see October and November unemployment rising. And I'm saying like it goes up like 0.4, 0.5%, something like that.
Yeah.
That would halt the Fed from, getting maybe all the way up to like 4.5%. Look, now we're just kind of getting into semantics at this point with, are we going to end up at 4 or 4.5? What's the range? Because that's going to kind of determine how massive the volatility is going to be over the coming 3 months.
Yeah.
If the expectation is just 4 or 4.25, then great. You're in either situation, any situation you look at, a dollar is going to be in a massive trend, most likely, unless the world goes back to a more stable geopolitical scenario, and people can work together again. Europe's not on the brink of collapse again. Russia's not going into depression again. China's producing more stuff again. But it seems like the order of that stuff is changing. We're going to be in that change for many, many more years. So a lot of the assumptions that we've built up kind of over the last few years we're going to need to carefully study the markets, carefully study the world, and update our belief system going forward.
So, for another summary, ING comes out very quickly with an article saying that very hawkish 75 basis point, another 75 in November, 50 basis points in December. They believe America's going to cut in 2023 at some point, and that the forex market is bracing for the descent. I heard was the second guy, whatever that guy's from, was CNN or Bloomberg or whatever he's from. He talked about peaking. He talked about are we peaking in interest rates? And Powell said no. So that was kind of what I thought. Not thought, but that's kind of my fear. That would really make the dollar weakening again. But yeah. Other than that, I think that is it. Raphael says it up. Wrap it up. My name is Embiro. First hit for 9 years. Made 8 pips on Euro sell. Joe with me on the side. Thank you guys, everyone, for joining in. Hope you have a fantastic day. Further.
Boom. Boom.